It's been a fascinating week in the financial markets, and one place that's particularly evident is the pound-dollar pair. That's because the central banks of the UK and the US have both met this week, two of many central banks meeting this week, but also both of which are considering tightening monetary policy in the not too distant future. Now, the Federal Reserve met on Tuesday and Wednesday, and yesterday announced that, or implied that, they are planning to start tapering their asset purchases in November, and also then potentially raising interest rates next year, with two more policymakers adding their names to the list of those supporting rate hikes next year. But really, even other policymakers are starting to increase their interest rate expectations over the course of the next few years as well. Inflation being key on this point, with the numbers coming in higher than previously anticipated. So even though growth is slowing and the risks to the outlook are mounting, it seems policymakers are becoming a little bit more concerned about the inflation data that they are seeing and the transitory nature of it. The UK Bank of England seem to be thinking along a similar path today. Now, we see that the asset purchases in the UK are due to come to an end, or net asset purchases are due to come to an end later on this year. Two policymakers actually voted to end them a little bit sooner than that. What's more, it seemed that the policymakers are starting to think the conditions have been met to raise interest rates next year. The markets had already been anticipating two interest rate hikes by the end of next year, but they brought those forward slightly, with some expecting a 15 basis point as early as February. So clearly, two central banks very much intent on the same path of travel in terms of tightening interest rates, also seeing inflation as a slightly larger risk now compared to what they'd previously anticipated, to the extent that they will consider raising interest rates next year, even though the next few months could be a little bit challenging for the economy, with a growing list of uncertainties, both domestic and abroad. And as you can expect, this has had a big impact on the pound-dollar pair. As you can see on the daily chart here, we've seen plenty of volatility in this currency pair now over the course of the last few days, and it has been quite interesting to see where we now stand. There's been a few interesting developments. One, we've broken back below the 233-day simple moving average band. We briefly broke through here back in August before rotating back above. So now we're back below. It seems that this is just a bit of a consolidation move. So I'm not going to get too excited about how bearish this is at this point. I think we need to see a break of those previous lows from July to suggest that this is finally a significant bearish breakout. But the pressure seems to be more to the downside than to the upside. But the flip side of that, of course, is that once again, we've come to these lows and we've failed to make a new low. And the rally that we're seeing in the pound against the dollar today may come as a bit of a concern for those hoping for a break below those 135.72 levels. If we do see a continuation of this bullish trend in the pound that we've seen materialize today, we've got that cluster of moving averages again above 55.89 band and the 200-233 band, and move through this level, through that 50 fib above 139, and all of a sudden things could be starting to look a lot more bullish for the pair. And the fact that we failed to make new lows on each of the last two occasions, despite rotations off the 50 fib and the break of the key fib of the key moving average levels, that would suggest that this is a pair that was appearing to be generating downside momentum, but we've seen clearly a bit of a stabilization. And that's obviously come from what I've just been talking about, the fact that the Fed has been expected to taper asset purchase and tighten monetary policy for some time. But expectations are clearly growing within the Bank of England, which makes these two central banks among the forefront of those expecting to be raising interest rates in the not too distant future. Obviously, plenty of others still are very far way behind, but that should make things interesting in this currency pair. Like I say, some key levels there. 135.72 is the lows. A break below here could really see momentum shift or accelerate to the downside. We're currently trading around 137.50. You can see that's prior support. Also, there you have the 233-day simple moving average, so moving back into that cluster band, but a breakthrough 137.50, and again 138, 139 though becomes the key level to the upside. And move through here, and things could be starting to look a lot more bullish for this currency pair. But clearly fascinating times ahead, and with so much uncertainty in the final months of the year, if we do see things take a turn for the worse, the Evergrande situation in China potentially being one, COVID of course with cases rising around the world and expected to rise again going into those winter months, the economic data, the energy crisis in the UK, that's just to name a few. There's plenty more downside risks that markets are keeping an eye eye on. And if they start to mount up, and if they start to materialize and translate into weaker economic data, then it's going to be a case of which central bank is going to blink first. And until then, we may see a little bit of consolidation in the pair. But when it does start to show a little bit of weakness, that could be when we do see a big breakout in one direction or the other.